Welcome back, everybody, to Magnolia on Money. This is Ed Cox with your weekly economic and market update. Today, we're going to discuss our financial indicators, and I like to bring these out once a quarter and let us kind of go back and see what they were maybe a month or so ago, and then how are things going right now. So, they're 20 indicators, and they are a good visual as to how the market and economy is doing. And it's pretty simple just to look at these little 20 indicators, kind of see real quick, hey, this has changed this much, or we're seeing a little bit of change over here in housing, which we'll get into a little bit. But let me go ahead and share my screen, and then you can kind of see where we're at here. So most of you have seen this before. These are what they call the speedometers, and the green represents a positive outlook. Neutral would be the yellow or orangey color, and then a negative outlook is indicated by a red. Now the actual let me get my pointer here so you can see. So the black speedometer needle is where it is currently, and if you can see the little gray. That was where it was last month. So if there was a change in that indicator, you'll see a gray needle there, followed by a black one next to it. So just to kind of give you an idea. So this is where we were last month in May. And let's jump ahead to June. So a couple of things I want to point out here. So housing is starting to see some pressure put on it with the Fed raising the interest rates. We're starting to see that affect new housing purchases. We're starting to see that prices are starting to fall. Now, there's certain parts of the economy, certain sectors of the U.S. that you're seeing housing prices that are continuing to rise, and some have been falling, for the last 6 months. But overall, when you look at the overall housing market and mortgages, 6 months ago, 30-year mortgage was running around 3%, and now it's over 5%. So that is starting to show some pressure on that, which is what the Fed wanted to happen. The next one is fiscal policy. So that's government spending. We're starting to see that's having some effect on our markets as well. Some of what the market had priced in for this year actually ended up not happening. So, when the government doesn't spend as much money, there's not as much out there for companies to report as earnings. And so that, we start to see a little bit of that affect the markets. And the last one is equity market valuation. So you're probably wondering, Ed, it looks like it's getting better. It is. As your stock market goes down in value, stock prices become more, the valuation of those stocks become better. Okay, so you're getting a better deal. Just think of it that way. So as the stock market goes down, equity valuations or market valuations get better. So that's why that continues to get better. And I wanted to go back and show you guys January of 2008. Now, January of 2008, I think the market had just started to go down. It may have been down like 2% right before the financial crisis. And I wanted to show you what these indicators looked like then. Big difference. Big difference. Almost every indicator is moving negative, negative, negative. There is 7 reds, just a couple of green, and that's because the monetary policy, the Fed started easing, and then, of course, market valuations got better as the market started to go down. So just I'll go back one just to show you now and right before then. So we're a far cry from that. Just wanted to show you that, comparison there. I've got some people that have asked me in the past, Ed, where do we stand compared to, past big market downturns? And I think we're sitting in a much better spot right now than we were back then. Economy is a lot stronger today than it was going into those some of those previous market downturns. So we're starting to get news and some predictions that we may actually avoid a recession. I'm kind of on the fence on that. I think it's possible if we can get energy costs down that we would, but I think if gas prices stay up, I think it may be hard for us to avoid a recession. How deep the recession will be, most economists are saying they don't really feel like it's going to be a very deep recession if we do have one. But that remains to be seen. These indicators are good ways to look at that and kind of see where we are and gauge the economy by true numbers and what's going on. So hope that's helped. God bless. Y'all have a great week, and we'll see you next week. Take care. Bye-bye.